Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about tax and financial advice and how heavily interrelated they are and how important it is to have a congruent tax and wealth building strategy. It's something that I see every single day of the week and certainly over the last 16 years of running Pro Solutions. So hopefully what I want to do in this podcast is just share some real life case studies, some client stories, and hopefully what it does is demonstrate to you how interrelated it is, and then I'm going to share with you what you can do to make sure that you're not missing out on any opportunities, because it's really important that the left hand knows what the right hand is doing. It's interesting that according to the ATO, about 70% of people have a registered tax agent that prepares their tax returns, so really a tax advisor. And according to some recent research by a fund manager called BlackRock, about 15% of Australians have a relationship with a financial advisor. Not surprising that number is really low, particularly given the stories coming out of the Royal Commission lately. So I doubt that number is going to increase significantly in the future as a result of those stories and the damage that financial planners have done to their reputation. But suffice to say that, you know, that small amount of people that actually have an advisor, the interesting thing is that accountants and advisors really talk to each other. So in 16 years of running a business, a financial advisory business, I've never had a client, or at least I can't recall, ever having a client's accountant ring me up and say, okay, Stuart, what's the strategy here? What's this client going to do? Because I'd be very open to having that conversation, sharing the strategy and making sure my client is going to get some really good tax advice. But it's never happened. So, which is a little bit alarming, and so what can you do to make sure these things are interrelated? So, let me share a few different stories, which is really just recent, last few months, where we've acted for the client as their tax advisor and financial advisor, and some benefits of working together as one holistic team. So, it's not a sell on Pro Solution, but what I want to do is use these stories to demonstrate how interrelated these matters are. Okay, so the first story I'd like to tell is about a client that had a hybrid discretionary trust, so which is a type of trust that we wouldn't normally or typically recommend. It has a bit of compliance risk, and we think they're misused to a large degree or oversold to a large degree. Anyway, because of some previous advice he received, he invested in a particular product that through a hybrid discretionary trust, and it didn't work out well. He made a large capital loss. So it was a large capital loss in this trust, and I was developing a financial strategy for him. And that financial strategy included investing in some property, but then also investing in some shares. And so I was thinking to myself, look, I don't really like the hybrid discretionary trust, but he's got about $70,000 worth of carried forward tax losses in this trust. And if I want to invest in shares, wouldn't it be good to invest in the entity that has these carried forward losses, so that eventually, if we ever sell down the shares, which I imagine we will do potentially in retirement, we can save a bit of tax. So I went, I got up from my desk and walked over to the accountant, and we had a chat about it. He went and I've got some legal advice. We got a lawyer just to put some documents together. Didn't cost very much to do that. And essentially we converted the hybrid discretionary trust into just a normal discretionary family trust, and we were able to utilize those losses. And so now we're investing in that way, and it's nice and congruent in terms of saving tax, but also building wealth. Another example is our accountant was preparing some financials for a self-managed super fund for a client. One client is retired, the other one is not. The one that's retired is obviously in pension phase. The one that's working isn't in pension phase yet. But she reached her preservation age during the financial year that the accountant was putting the returns together. So he came over and spoke to me and said, well, maybe the wife should be in pension phase now in order to reduce the amount of tax that the super fund pays. And so that was picked up nice and easily. And I guess it's and so obviously going to save the client some tax naturally in the super fund. And I guess it's an example of taking that holistic approach, not just for accountants burying their head in just pumping out the financial statements and tax return, but really taking a step back and looking at holistically at the investments. Another plan that I was working on probably about a year ago involved some clients that were self-employed, and they were distributing into a company, distributing some profit into a company, a non-trading company, just to really cap their tax rate at the corporate tax rate at 30%. But that crystallised what's called Division 7A liabilities. And it gets a bit technical and messy, but the structure is just a bit technical and messy. Essentially, watering it all down, they had some profit in the company, and they had two choices: leave it in the company and invest it there, or take the money out of the company, and then they'd have to pay tax at marginal tax rates, or they get some tax credits, but they'd have to pay a little bit more tax and invest it in an entity that's more tax effective. And so what we determined was best for these clients is that part of the strategy included investing in property. And so what we said to them is, look, let's have the company own 20% of the property, and we can use the retained profits in that company to fund that 20%. And then you as individuals can own the remaining 80%, and they actually owned it as 40% each. The both spouses had 40% holding each. And that way it balanced out all the tax outcomes, but still allowed them to invest in quality assets and minimise the amount that they needed to borrow. Or at least they had the amount in the company was completely offset. So a perfect approach to resolving what could be a potential tax planning issue in the future and tax compliance issue, with making sure that the overall investment strategy was congruent as well. Another one is one that I worked on this week, which is some clients that they wanted to upgrade their home. In order to do that, they need to maximise their borrowing capacity. But naturally, when an accountant puts tax returns together, their goal is really to minimise taxable income. So find as many deductions as possible to obviously save the client tax. That's the accountant's role. The unfortunate side impact of that, however, is that it also reduces a client's borrowing capacity. So it's great to save on tax, but then if you're sort of cutting your nose off to spite your face, because then you can't go and borrow to achieve your lifestyle or investment goals. So what we were able to do, acting as accountant and financial advisor for this client, is certify to the bank that, hey, there were some non-reoccurring expenses in that financial year that aren't ongoing. And because we have such a strong relationship with that bank, and the bank can obviously places a lot of reliance on that certification, we were able to get the bank to rely upon the higher normalised income rather than the income represented in the tax return for that particular year. So a really good example how tax and financial planning advice can be interrelated. I think we can take that one step further to say that, look, if we had a conversation with the client about what their plans were, we could make sure that the tax return is prepared in a way that's going to help us achieve those plans. So it's really about understanding, if you're going to want to go out and borrow, then tax minimisation might not be the highest priority that year. In a year that you're not necessarily going to go out and borrow, then go hell for leather on tax minimisation. The last example would be super contributions, particularly for self-employed people. Self-employed people can obviously make tax-deductible contributions into super. It gets a bit technical because there's two types of contributions you can make, employer and personal, and it really depends on whether you make them personally. Well, not really. Actually, it depends on whether you make them personally or through an entity and so forth. And if you get it wrong, you potentially get denied a tax deduction on the other end. So it's great for financial advisors to say, yeah, make contributions, but it's also then really important you go and speak to your accountant to make sure, how are these contributions going to be classified? Are they personal? Are they employer? Because that's going to affect the tax deductions on the other side. So I would say that the more complexity you have, the more important it is for your accounting advice, tax advice, to be congruent with your financial advice. So if you have relatively simple situations, so a simple situation to me would be, say, few investments, no entities, so no companies, trusts, or self-managed super funds. You're not self-employed. So if you can tick those three boxes, I'd say that you've got a simple situation, and therefore that the theme of this podcast probably doesn't really apply to you. But if you do have some complexity, so entities or a lot of investments, or you're self-employed, this podcast is exactly for you, and you really then absolutely need to make sure that your financial and tax advice is interrelated. So what can you do about it? Well, obviously you can be the conduit to sharing that information. So if you're using a tax advisor and a financial advisor that aren't in the same firm, or you're doing your own financial advice, really then it's up to you to be the conduit of that information, and making sure, well, the onus is really on you to make sure that you actually communicate that information correctly as well, because sometimes I've had clients go and speak to their accountant and they've not used the right terminology, and they've sort of misrepresented what's happening to the accountant, and it can create some problems. So that's one option. The other option is obviously to use one firm, so that you've got a whole team that's looking after your financial situation, so that nothing slips between the gaps. And I guess there's two advantages to that. The first one is that, we're all time poor. So, if we've got various advisors in different locations, what it means is we'll have to provide the same information to them and have the same or similar discussions with them multiple times, and it's really a waste of time. Whereas if you've got one group, one team looking after you, potentially, I know for our clients, they'll come in and depending on their needs, we can have a conversation about tax, financial planning, mortgages and insurance all in one meeting. And that might require different people to be in the meeting at different times, but that's no big deal. It certainly saves the client a lot of hassle and time, but also it makes sure that we all know what's going on. And so if there's some changes in, say, mortgages, then how does that impact on levels of insurance or types of insurance and so forth. Secondly, nothing slips between the gaps. So when I'm formulating an investment strategy, then I can, and I've got questions about tax related matters, I can just get up and talk to the accountant in our office, and we can have a discussion, kick some ideas around. Nice and easy to make sure, and that way the accountant then also knows what's going on with the client. Similarly, it works in the other direction. If the accountant's doing something from a taxation perspective, and he thinks it's going to impact borrowing capacity or anything on the wealth side or so forth, then he can get up and talk to me, and we can kick some ideas around. Lastly, and it sounds a bit control freakish, but if I give advice to a particular client, I know we're looking after the tax side, I know that advice is going to be implemented correctly. However, if I give advice to a client and they've got an external accountant, whilst there's some great accountants out there, there are also some accountants that don't have as much knowledge, and they can mess up an otherwise good plan. So at least the implementation, when you're using the one firm, it's going to be correct. Now, a lot of people don't realise that accountants can't give you financial advice. So you can only provide financial advice if you're authorised under an Australian Financial Services licence. And so a lot of accountants are concerned about their liability with respect to giving advice, so a lot of accountants won't go near it. So even just basic things like, should you contribute into super, where your super's invested, should you start a self-managed super fund, those sorts of things, a lot of accountants are reluctant to provide advice on. And as I said at the beginning of this podcast, accountants tend to spend most of their time looking at what's happened in the past rather than asking questions or understanding about what's happening in the future. So, they'll pump out a tax return for the last financial year, and they're so busy doing that, they tend to then move on to the next client before asking the current client, hey, are there any changes in your circumstances, or what are your plans in the future? And that's not I'm not having a go at accountants, that's their job, whereas a financial planner's job is really to look out into the future. And those two people need to be talking, I think. I think it's potentially dangerous that your tax advisor doesn't know what your financial plan is. So if you're missing out, or if you're not confident that your crystallizing all the financial opportunities or all the things are slipping between the gaps or that your advice isn't congruent, what can you do? Well, as I said, you can obviously use a team of people. So find a practice like mine that provides holistic advice, that look after all your needs and make sure nothing slips between the gaps and everything's congruent, or you can take that role. And you've got to then understand that the onus is on you to make sure that you're sharing as much information as possible. And there's no such thing as too much information, in my opinion. Obviously, you want to make sure that your advisors are actually open to receiving that information and that they're on the same page in terms of helping you and giving you proactive advice. So there you go. I hope that's been helpful to help you understand the importance of integrating financial and tax advice, and all the best with your investing. And obviously, if you like this podcast, you enjoy the podcast, please do rate it on leave me a rating on iTunes in the podcast thing. That'd be great. Excellent. Until next time. Bye for now.